market is the world's largest financial market, and it plays a vital role in the global economy. Every day, trillions of dollars are exchanged from one currency to another. This kind of currency exchange is essential for international business. Forex market participants include governments, businesses, and of course, investors. Governments use the Forex market to implement policies. For example, when conducting business with another country, whether it's borrowing money, lending money, or offering aid, a country needs to convert its currency into a foreign currency. Businesses use the Forex market to facilitate international trade. For example, they may need to convert payments for goods and services bought overseas or to exchange payments from international customers into their preferred currency. And investors use the Forex market to speculate on changes in currency prices. Currency prices change almost constantly during the week because the Forex market is open continuously from Sunday at 4 p.m. until Friday at 4 p.m. Central Time. A trading day starts at 4 p.m. and ends at 4 p.m. Central Time the following day. The market has to be open around the clock because of the global nature of the economy. Let's go over some basics of how trading Forex works. When you trade Forex, you're not just trading one product. You're trading two currencies against each other. This is known as a currency pair. The quote for a Forex currency pair defines the value of one currency relative to the other. The easiest way to understand any quote is to read the pair from left to right. Let's look at an example using the euro versus the US dollar currency pair. If the EUR-USD is trading at 1.20, that means 1 euro is equal to $1.20 US dollars. Here's another example using the US dollar versus the Canadian dollar currency pair. If the USD-CAD is trading at 1.25, that means 1 US dollar is equal to $1.25 Canadian dollars. Even though there are two currencies involved, the pair itself acts like a single entity, similar to a stock or commodity. And just like when trading stock, investors profit when they buy a currency pair, and its price increases. Investors can also profit if they sell or short a currency pair, and the price decreases. Let's look at an example. Suppose an investor thinks Europe's economy is going to grow faster than the United States, and as a result, she thinks the euro will strengthen against the US. Conversely, if the price falls, she'll experience a loss. Now that we've covered the basics, let's look at a few key aspects of the Forex market. We'll start with margin. When you trade on margin, you only need to put up a percentage of the total investment to enter into a position. This amount is known as the margin requirement. When you trade other securities like stocks, trading on margin means you're borrowing funds from your broker. However, Forex trades can only be covered using funds in the investor's Forex account. Investors can't borrow funds to enter a Forex trade. If they don't have funds in their Forex account, they need to transfer funds before placing a trade. Forex margin requirements vary depending on the currency pairs and the size of a trade. Currency pairs typically trade in specific quantities known as lots. The most common lot sizes are standard and mini. Standard lots represent 100,000 units, and mini lots represent 10,000 units. Depending on your brokerage firm, you may also be able to trade Forex in 1,000 unit increments, also known as micro lots. Margin requirements can be as small as 2% of a trade or as large as 20%, but the margin requirement for most currency pairs averages around 3 to 5%. To understand how margin is calculated, let's look at an example using the euro versus US dollar pair. Say this pair was trading at 1.20, and an investor wanted to buy a standard lot or 100,000 units. The total cost of the trade would be $120,000. That's a lot of capital. However, the investor doesn't have to pay that full amount. Instead, she pays the margin requirement. Let's say the margin requirement was 3%. Forex market. Leverage. Leverage enables investors to control a large investment with a relatively small amount of money. In this example, the investor is able to control $120,000 with $3,600. The leverage associated with currency pairs is one of the biggest benefits of the Forex market, but it's also one of the biggest risks. Leverage gives investors the potential to make large profits or large losses. One more important element in the Forex market is financing. This is the calculation of net interest owed or earned on currency pairs, and it happens when an investor holds a position past the close of the trading day. The US dollar is associated with an overnight lending rate set by the Fed, and this rate defines the cost of borrowing money. Similarly, each foreign currency has its own overnight lending rate. Remember, when you trade a currency pair, you're trading two currencies against each other. Even though the currency pair acts like a single entity, you're technically long one currency and short the other. In terms of financing, you're lending the currency that you're long and borrowing the currency you're short. This lending and borrowing occurs at the overnight lending rate of each respective currency. In general, an investor receives a credit if the currency he is long has a higher interest rate than the currency he is short. Conversely, an investor is debited if the currency he is long has a lower interest rate than the currency he is short. Let's look at an example. Suppose an investor has a position in the Australian dollar versus the US dollar currency pair. Say the overnight lending rate for the Australian dollar is 2% and the overnight lending rate for the US dollar is 1%. The investor is long the currency pair, which means he is long the AUD and short the USD. Since the AUD has a higher interest rate than the USD, the investor will receive a credit. However, if the investor was short the AUD-USD currency pair, he'd have to pay the debit because he's short the currency that has a higher interest rate. Financing is performed automatically by your brokerage firm. However, it's important to understand how it works and its financial impact on the trade. We've reviewed just a few elements of the Forex market. As with all investment opportunities, the Forex market has a unique set of risks and benefits, and education
Yuan is equal to one US dollar. And every time I say dollar in this video, I'm referring to the US dollar is equal to 1 US dollar. And I think this makes sense to a lot of people. If I have $1, I want to convert it to won. I get 10 of them. If I have 10 won, I want to convert it to dollars. Someone's going to give me $1 for it. Now let's imagine a situation, and in the next few videos I'll construct actual trade imbalances where this would actually happen. But let's say we live in a reality where there are 1,000. So let's say, someone has 1,000 won. So let's say that this person right here, has 1,000 won. Let me write over here. Has 1,000 won and wants to convert to dollars and wants to convert to dollars. Now let's say on this side, and if we just superficially looked at this 1,000 won and looked at the quoted rate, we'd say, hey, that 1,000 won, you get 10 won per dollar, so that should be $100 at the quoted rate. But let's say you have two other actors over here. And obviously these markets involve many, many more than just three people, but this will help us simplify or at least understand how these exchange rates would work. Let's say that this person right here, with the mustache, let's say that this person right over there, and maybe a hat as well. Let's say that he has $50. Let's say he has $100. Has $100 that he needs to convert to won. Maybe he wants to buy some Chinese goods. Maybe he's a Chinese factory owner who sold his goods in the US for $100, and now he needs to convert it back to won to pay his employees or pay his own mortgage or who knows what. And let's say that there's another person. Let's say that there's another character over here. There's another character over here. And let's say that she also has $100 that need to be converted into won. So net, what's happening here? What's the total demand to convert won into dollars and dollars into won? Well, if you look at the whole market, you have $200 that need to be converted into won. Let me write this down. We have a situation where $200 need to be converted.
Talk about how to convert currency given the currency exchange rate. So in this problem, John has 15,000 US dollars that he wants to convert into euros. How much money in euros will he receive? Now we're given the currency exchange rate or the conversion factor. 1 US dollar is equal to 0.9 euros. So how many euros is 15,000 US dollars? So let's convert it. First, start with what you're given. We're going to write that number on the numerator of a fraction. Now, in the next fraction, we're going to put the exchange rate in it. We want the unit US dollars to cancel, leaving behind the unit euros. So there's two parts to this equation, 1 US dollar and 0.9 euros. One of them will go on the top of this fraction, and the other will go on the bottom. The question is which one? Now, notice that we have US dollars on the top in the first fraction. One of them will go on the top of this fraction, and the other will go on the bottom. The question is which one? Now, notice that we have US dollars on the top in the first fraction. In order for that unit to cancel, we need to put that same unit on the bottom of the second fraction. So we're going to put this part on the bottom part of the second fraction, which means the right side of the equation has to go on top. So you want to set it in such a way that these units will cancel. If you do that, you're going to get the right answer. So now, because these two numbers are on top of the fraction, we need to multiply. So it's going to be 15,000 times 0.9. And so the answer is 13,500 euros. So that's how you can convert from US dollars into euros. Now, keep in mind, the currency exchange rate that you see here, it changes every day. So tomorrow, that rate might be slightly different than what you see. So if you're going to convert US dollars into euros, you need to find out what the exchange rate is for that current day. So just keep that in mind. Now let's move on to the next problem. Kim has 30,000 Canadian dollars that she wants to convert into US dollars. How much will she receive in US dollars? Now we're given the exchange rate of 1 US dollar is 1.31 Canadian dollars. So using this information, go ahead and get the answer. So let's start with what we're given. That is 30,000 Canadian dollars. We're going to write this over 1. Now, in the next fraction, we're going to write the two parts of our conversion factor, or the exchange rate. So, the 1 US dollar, where should that go? And where should we put the 1.31 Canadian dollars? Should we put the 1.31 Canadian dollars on the top of this fraction or on the bottom? What would you say? So looking at the fact that we have the unit Canadian dollars on the top part of the first fraction, we want to put that same unit on the bottom part of the second fraction. Keep in mind, we want the unit Canadian dollars to cancel because we want to convert it to US dollars. So we want the other part of that equation to be on top. So our final answer will be in US dollars. Now, notice that this number is on the bottom. So for this problem, we need to divide as opposed to multiply like we did in the first problem. So when you're dealing with fractions, if you have a number on the top of a fraction and one on the bottom, you need to perform division. In the last problem, we had a number on top. In this case, we need to perform multiplication when dealing with two numbers on top of a fraction. So to get this answer, it's going to be 30,000 divided by 1.31. And so Kim will expect to receive 22,976 cents. So that's how much US dollars she expects to receive. Let me put the unit USD. So that's it for number
Is think about how exchange rates can affect trade.
And actually, we can even think a little bit about how they might be able to affect each other, although we'll go into a lot more depth in that in future videos. So let's just imagine a situation where the Chinese yuan depreciates versus the dollar. Depreciates versus the US dollar, to be clear. US dollar. And to visualize what we're talking about, let's draw the supply and demand, or the exchange market for the Chinese yuan. So our horizontal axis would be quantity of yuan, and then our vertical axis would be the price of yuan in terms of dollars. So dollars per yuan. And we've seen this before. This right here would be the supply of yuan. So these would be the people who are holding yuan but might be willing to exchange them into dollars. And then this would be the demand for yuan. These are the people who are holding dollars who might be interested in exchanging them for yuan. And there will be some equilibrium exchange rate. Let's call that E sub 1. And let's call this, and some equilibrium quantity per time period. Let's say call that Q sub 1. And just to be clear, this is our supply curve for the yuan, and this is our demand curve for the yuan. And so a situation where the Chinese yuan depreciates versus the dollar, there's two ways really that could happen. One, you could have the demand for the yuan shift to the left, or you could have the supply of yuan shift to the right. The demand shifting to the left would mean for some reason people who hold dollars are less interested in getting yuan, and supply shifting to the right would mean people who hold yuan are all of a sudden more interested in getting dollars. So actually, let's just do the latter one. So let's say the supply shifts to the right. I just want a scenario where we have the Chinese yuan depreciating against the US dollar. And so you see very clearly in this world, if our demand does not shift, we get to this next equilibrium exchange rate, E sub 2. And there's also a different equilibrium quantity. But you can see the Chinese yuan has depreciated versus the dollar. If E sub 1, maybe E sub 1 is 15 cents per Chinese yuan, and maybe E sub 2 is 10 cents per Chinese yuan. But now that we understand, we can visualize what we're talking about, what would be the impact on trade? And I'm going to think about it in two ways. What is going to happen in China? Let's think about China first. So in China, or we're going to be thinking about the Chinese consumers. Well, Chinese consumers, they hold yuan, and they might buy some American goods. And what would happen to the cost of those American goods? Well, assuming that the American suppliers offer their products in a fixed dollar price. So let's say you are General Motors, an American car company, and there's a car that's manufactured in the United States, and it costs $20,000. Well, in a world where the Chinese yuan depreciates versus the dollar, the amount of yuan to equal 20,000 US dollars has now increased. You need more yuan per dollar because you're in a world where there's fewer dollars per yuan. So American goods, more expensive in China. Expensive in China. And so what might that do to the behavior? Or how might people decide to trade off between American and Chinese, let's say in this example, cars? Well, if American goods, in this example cars, become relatively more expensive, then they're likely to buy fewer American cars. And so if we're talking about all American products, we could say American imports into China will go down because they're going to be relatively more expensive. Now, what about in the United States? In the United States, what is going to happen? Well, assuming that Chinese goods are offered by the supplier at a fixed yuan price, well, now you need fewer dollars per yuan. So Chinese goods are going to be less expensive to American buyers, so less expensive in the U.S. because each dollar is going to buy more yuan, and assuming that the goods have a fixed price in yuan. And so you could say Chinese imports into the US are going to go up. And what's interesting is that you might have a little bit of a negative self-correcting feedback loop. Because what's likely to happen if American imports into China go down? Well, that means that fewer Chinese folks are going to be interested in converting their yuan into US dollars in order to buy goods because they're not buying as many American goods. And so that might have the effect of shifting the supply curve back to the left. Similarly, in a world where Chinese imports in the United States go up, well, now all of a sudden more Americans will be interested in converting their dollars into yuan, and so that might shift the demand curve to the right. And so either of these could have the effect of maybe helping the Chinese yuan appreciate a bit. Now, in previous videos, we've talked about many factors that could shift the supply or demand curve for a currency to the right or the left. But it would be interesting to think about what would be the effects of interest rate changes in each country. And now we can link it not just to what would happen to the supply and demand curve, but we could think about how that might affect trade. Let's imagine a situation where the U.S. government increases borrowing. And we've talked about this in previous videos. That will likely lead to increased interest rates because you have a big borrower here. You could even have a crowding out effect because of the increased interest rates. Fewer private borrowers in the U.S. might borrow. But this would likely, doesn't always, increase interest rates in the U.S. Now, if you have increased rates in the U.S., what might happen for folks in China? Well, they might say, hey, we are more interested in holding dollars because we could, in a dollar bank account, all of a sudden we get more interest. And so that could have the effect that we saw earlier, where it could say, hey, more yuan holders are interested in converting into the US dollars. So it would shift the supply of yuan to the right, which would have the impact of depreciating the Chinese yuan, which is where we started this video. And so you could see something like the US government borrowing, which increases interest rates, can actually have an impact on trade. It could actually make American goods less competitive in China and Chinese goods more competitive in the United States. And I just did a scenario where the supply curve shifts to the right. But you could also imagine a situation where government borrowing, increasing the interest rate in the United States, could even change the demand curve. Remember, the demand curve is going to be determined by the sentiment from dollar holders and how much they want to convert to the yuan. But if interest rates in the United States go up, well, now they might say, hey, I might want to save in the United States as opposed to investing in China or converting my money to yuan and saving in Chinese bank accounts. So I'll leave you there. The big thing to appreciate here is that exchange rates and trade are very linked, and that things like government borrowing can affect interest rates, which can affect exchange rates, which can affect trade.